Picture this for a moment. It's a quiet Thursday morning in Singapore. The city is already moving outside your apartment window, but you are in no rush. You make breakfast, check your phone, and notice dividend payments arriving in your account overnight. No commute, no meetings, no manager waiting for you. Just income flowing in while you sleep. That reality is becoming increasingly common among Singaporeans focused on long-term investing. And today, we are going to break down exactly how much money you realistically need invested to live entirely off dividends forever. The surprising part, the target is probably closer than most people think. Before we get into the calculations, there is one huge advantage Singapore offers that many investors around the world overlook. Dividend income here is generally tax-free for individuals. When Singapore-listed companies pay dividends, investors usually receive the full amount. No withholding tax, no extra personal tax reducing the payout. Compare that to many Western economies. In Germany, investment income can face taxes above 25%. In Japan, dividends are commonly taxed around 20%. In Canada, dividend income can still be heavily taxed depending on your bracket. Singapore chose a very different approach decades ago, and that single decision changes the entire equation for passive income investors. A portfolio yielding 5% in Singapore actually gives you close to 5% cash flow in your pocket every year. So the next question is simple. How much does life in Singapore actually cost without a salary? Government surveys place average household spending above $5,000 monthly, but lifestyles vary. To simplify things, let us use 3 realistic targets. For a single person living comfortably, around $2,800 monthly is reasonable. That equals roughly $33,600 per year and covers rent, transport, food, healthcare, and some entertainment. For a couple wanting a more relaxed, middle-class lifestyle with regular dining out and occasional travel, $5,200 monthly or around $62,400 annually is a more comfortable target. And for people aiming for a premium lifestyle with condo living and frequent overseas trips, expenses can rise to $8,000 monthly or $96,000 per year. Those are the income targets your investments need to produce. Now here is where Singapore stands out again. Many of the country's major companies are known for strong dividend payouts. Singapore's 3 major banks, DBS, OCBC and UOB, have recently delivered yields between roughly 4.5% and 6% after strong earnings growth. Then there are Singapore REITs, which distribute most of their rental income directly to investors. Several diversified REIT ETFs have historically yielded close to 5%. Build a portfolio combining banks, telecoms, utilities and REITs, and a realistic long-term dividend yield of around 5% becomes achievable without taking extreme risks. So let us run the math using that 5% yield. To generate $33,600 annually, you would need about $672,000 invested. To generate $62,400 yearly, you would need around $1.25 million. And to generate $96,000 annually, you would need close to $1.92 million invested. And remember, because Singapore's dividend system is so tax efficient, most of that income stays with you. Now, here is the encouraging part. These targets are not reserved only for wealthy families. Many ordinary salaried workers can realistically reach them with consistency and time. Suppose you invest $1,200 every month into diversified dividend investments, averaging around 7% total annual return through reinvested dividends and moderate growth. In that scenario, crossing the $650,000 mark could take around 20 years. Someone starting in their late 20s could realistically build meaningful passive income before traditional retirement age. Increase the monthly investment amount and the timeline shortens even faster. There is also another tool many Singapore investors fail to maximize, the Supplementary Retirement Scheme or SRS. Contributions to SRS reduce your taxable income immediately, while the money inside can still be invested into stocks, ETFs, and REITs. Later in retirement, only part of the withdrawal becomes taxable, making the system highly efficient for long-term compounding. Many experienced investors therefore use two accounts: SRS for retirement-focused investing and a separate brokerage account for passive income they may want access to earlier. But there is one major mistake that traps many beginner dividend investors: chasing extremely high yields. If you suddenly see a stock yielding 11% or 12%, that should make you cautious, not excited. Often, the market is warning you about deeper problems. The company's share price may have collapsed, profits may be weakening, or future dividends could be cut. In fact, most investors would probably perform better by keeping things simple rather than constantly trying to pick winners. Broad Singapore ETFs already provide exposure to many of the country's strongest dividend-paying companies in one purchase. A fund tracking the Straits Times Index gives access to Singapore's leading corporations with a yield that has often hovered between 3.5% and 5%. Pair that with a diversified REIT ETF and investors gain exposure to commercial property income across offices, malls, logistics centres and industrial spaces. The result is a diversified income portfolio requiring very little active management. Boring? Maybe. Effective over 20 years? Extremely. Another thing dividend-focused investors quickly notice is that payout timing matters psychologically. Singapore companies distribute dividends at different periods throughout the year. Some REITs pay quarterly, others semi-annually, while many blue-chip companies issue interim and final dividends separately. Experienced investors intentionally combine holdings with different payout schedules, so income arrives almost every month. Over time, this creates something resembling a salary replacement system. Cash flow appears regularly throughout the year without relying on employment income. That steady rhythm is what makes dividend investing feel tangible and sustainable for many people pursuing financial independence. So, to summarize everything, depending on your lifestyle expectations, living entirely off dividends in Singapore may require somewhere between roughly $670,000 and nearly $2 million invested. The path there involves steady investing, long-term compounding, avoiding risky high-yield traps, and taking advantage of Singapore's tax-efficient investment structure. The fact that dividend income is largely untaxed is not some small technical detail. Over 20 or 30 years, that advantage can preserve an enormous amount of wealth that investors in many other countries lose to taxation. And that is one of the reasons Singapore continues to stand out globally as a powerful place for long-term dividend investing. If this video changed the way you think about passive income and financial freedom in Singapore, make sure to like the video and subscribe for more deep dive content on wealth, investing, and global economic trends. See you in the next one.